Welcome back. Well, the markets are looking quite good, but a couple of problem pockets, though, in the broader markets. Case in point being a D-Link as well. That's another stock that's down close to around 6.5–7%. Also, some accidents in the broader markets, more or less, the trend is positive. Let's move on, though. Equitas Small Finance Bank, the quarter four results came in a little over what the street was estimating. The return ratios, that's something that's looking very, very good. To understand what's the way ahead from here on, we're joined by Mr. P.N. Vasudevan, the Managing Director, as well as the Chief Executive Officer at the company. Hi, Mr. Vasudevan. Good morning and congratulations on a rather good set. Now, when we last spoke, you were telling us that from the AUM base of around 28,000 odd, growth can be quite strong. You're talking about 25 to around 30% odd. Now, by 2025, do you think this AUM could move to around 45,000 crores? Point number one. And also your NIMs are holding around that 9% odd mark. But because of the change of the composure of the book, we could see some bit of petering down. What's the average NIMs we should be working with for FY24?
Good morning. So we have been guiding for a growth of around 25 to 30% per annum. And I think given the size of the bank, our advances are around 20, just under 28,000 crores. Given that size and given the kind of market potential in the segments that we operate, we believe that this 25 to 30 is something that we should be able to maintain over the next few years. And if you're saying 45,000 in 2 years' time, that's something that we can work out, but I assume that that's where it should land in a couple of years if we can maintain this growth. As far as the NIMs are concerned, yes, it's kind of held around that 9% level in the last couple of quarters. But going forward in the medium term, let's say over the next 2 to 3 years, as we introduce new products, which will have a slightly higher ticket size, and which means that our operating cost and credit cost could probably be lower. The yield will be lower on those kind of products and segments. And so the overall NIM over the next 2 3 years might come down just a bit. But the spread should be generally maintained because proportionately there should be a reduction in OPEX and credit cost.
But NIMs then we should work with what, 8.5%?
I think in the next 2 to 3 years we should reach those levels. Yes.
Or even lower, could be even lower. What's the sense?
Well, you know what, the NIM will be actually a factor of the kind of product mix that we have. So currently we have a product mix which yields the current NIM that we have. The new products that we are looking at, like a personal loan or a credit card, etc. I know they are going to take some time. That probably the personal loan should get launched in the second half of this year. And so they're not. We are not really introducing too many new products in a short time frame, which may have a lower yield. So I think this 2 to 3 year, 8.5 is a decent number to look at.
Right. Mr. Vasudevan, my colleague Abhishek points out that your loan book tenure in the last 2 quarters has gone up. And this is on account of lower principal repayment and higher interest payment. When principal component in the EMI actually increases, could that also impact your estimates of how fast loans can grow?
Well, there was a temporary, change in this principal interest to mix because of the restructuring that was done about a year back, in the 2021. So that was done for about 10. That's not going to hopefully not repeat again. So I don't think that should be a material issue as far as the advance growth should be concerned.
Okay, so you spoke about 25 to 30% growth that you can maintain over the next few years. But we are also seeing, the EMIs increase, rates are going up. Do you think that would put pressure on growth? Because the two segments that you have seen very strong growth in is the CV portfolio and the MFI segment. Now, in the CV portfolio, for example, in the CV industry, there are some signs of a growth slowdown. Do you think despite all of that, you can maintain this 25 to 30% growth in those pockets as well?
See, our vehicle finance contributes about 25% of the book today. And out of that, 40% comes from the new small commercial vehicle, and the balance 60% comes from used commercial as well as used car segments. So the used car and the used commercial vehicle segment generally, is the last to be impacted in terms of GDP changes. The new vehicles are the ones which are more likely to be quickly impacted. So for the next 1 year, at least with the expected GDP around the 6% plus level, even the CV is expected, even the new CV is expected to do decently well. But that's only 40% of our vehicle finance. The back 60% is used where we don't really think that there should be much of an issue from a demand perspective. As far as the microfinance is concerned, sorry, go ahead.
Please go ahead. Please go ahead.
So as far as the microfinance is concerned, sure. As far as the microfinance is concerned, it's contributing about 18.7% to the total book today. And so over the next 5 years, we expect that to come down to maybe about 14-15%. So I don't think, generally microfinance, the demand remains fairly steady throughout. But because other businesses will grow and there will be some new products introduced, the contribution of microfinance should come down to around the 14-15% over the next 4 to 5 years.
Okay, I just had one follow-up here. You said that 25% of your book comes from vehicle finance, and within that 40% comes from the new CVs, and there is small CVs as well in that. So like LCVs, for example. But between the two pockets, where are you seeing higher amount of growth come through? Because, in the LCV segment, there is this whole resurgence of growth because of e-commerce, logistics picking up. But in large commercial vehicles, not so much. Can you give us a breakup of how things are looking and what is the growth trajectory that you can maintain in vehicle finance?
The new commercial vehicle, we are actually doing only the small commercial vehicle type. The small commercial really means like your Tata Ace and AL, those kind of vehicles, pickup, M&M pickup. So we are really targeting only that segment right now, and that's contribute 40% of the vehicle finance. And these are intra-city movements. These vehicles are really intra-city. They are not really the intercity or the long-haul vehicles. We are right now not into the heavy commercial or even the light and intermediary vehicles. Really not that segment yet. We have started that at some point in time. So the small commercial vehicle generally is a lot more resilient even during a slightly downturn GDP, fundamentally because they address the local requirements and not so much the the heavy goods movements.
All right, Mr. Vasudevan, besides the numbers, your return ratios are looking very, very impressive. I wanted your guidance out here. The ROAs, the ROEs, and also if you could tell us what is credit cost likely to look like for FY24. I think you were hinting at around 1.5% earlier.
So last year, FY23, we had guided for a 1.5% credit cost, and we ended up the year at just about that 1.5% level. This year, we predict credit cost, which should be more closer to our pre-COVID level, because our GNPA, last year we started with a GNPA of over 4% last financial year. But this year we are starting with a GNPA of 2.6%, which is actually the same as our pre-COVID levels. So our GNPA has come down to the pre-COVID level. So we expect the credit cost also to come back to the pre-COVID level. And pre-COVID, our credit cost used to be around that 1.25% level. So this year we expect the credit cost to be around that 1.2 to 1.25 level. And if that happens, then I think the bottom line should be healthy, for the year.
And return ratios, you were telling us, some are estimating the ROEs could move to around 18% in the next few years. Possible? ROEs and ROAs, where do you see that moving?
Well, we are not guiding on the return ratios, at this point in time. But with the credit cost coming down and the top line business growing around the 25% plus level, I think yes, we should be able to generate a decent bottom line of ROAs and ROAs. And we are also fairly under leveraged now.
Sure. Sure.
So our capital adequacy ratio is still 24%. So we are fairly under leveraged. So that leverage also should help the ROE going forward.
Okay. And on your restructured book, that is at about 0.8%. There's a sharp improvement that we've seen compared to last quarter. Can you explain that to us, and will it continue to further improve in the quarters to come?
Yes. So we rescheduled nearly 10% of the book in 2021, October to December. I think it was probably one of the highest among the banks. There was a lot of concern raised by many people whether that restructured book will bring us a lot of grief and all that. But our customer segment is such that if they are able to open their shop and if they are able to get back to the normal life, their cash flow becomes quite comes back quite fast. And so we have not seen much of a pain from our restructured book. and today it has come down to just under 1%. And basically because most of the loan agreements have either been paid off and they've just run down or been paid off, or they have been upgraded to standard assets from restructured. After restructuring, if the customer pays
Right.
the EMI properly for a particular period of time, then it gets upgraded to a normal account. So either they got upgraded or they got paid off, or some of them became NPA, and so they moved out to the NPA or got written off or whatever. So finally, now we are just left with under 1%. So going forward, and against that, we will have 89,
Right.
88% for NPA also. So we don't think that restructured. Actually, I think we have really helped our customer by restructuring significant number of clients, so that
Got it.
they can pay back slowly and then retain their security. They've given their house property
Yes.
first, and they've been able to retain their house property.
Right. Mr. Vasudevan, excellent set of numbers and great conversation, sir. Appreciate you joining in with that perspective. Congratulations once again. And until the next time we speak. By the way, look at the market. It's up 145 points.